Hey everyone, welcome back to the channel. Today I want to talk about an option trade that I have recently done. Many times I've heard from people that they will buy the stock and sell the out of the money call options. Well, I've done it before too. In fact, I've done many out of the money call options before, getting premiums from the stock that I hold. But recently, I've learned about selling in the money call options. And I got this idea from John, the creator of CPT Trading. He is really good at selling options for premiums and getting lots of cash flow. I'll put the link of his channel in the description below. So today I want to share a real option trade that I recently completed using TQQQ and an in-the-money covered call. This is not paper trade, this is not backtesting, this is real trade with real money. I'm going to walk you through exactly what I did, explain every possible outcomes using real numbers, and at the end, I'll review how this trade actually turned out. And as always, this is not financial advice. Everything I say here is for entertainment and educational purposes only. Please do your own research and invest based on your risk tolerance. Now let's start from the beginning. On 5th January 2026, I opened this trade. I bought 200 shares of TQQQ at $54. At the same time, I sold 2 contracts of in-the-money call options. The strike price was $51.50. The expiration date was 16 January 2026. And the premium collected was $3.48 per share. So that means I've collected $696 upfront, and my effective cost basis on the shares immediately dropped to $50.52. Now, this number is the foundation for everything that follows. Now, here from the chart, you can see on 5th Jan, I placed the trade. I bought 200 shares at $54. I sold 2 contracts that expired 16 Jan at a $51.50 strike price. The premium collected was $3.48. My cost basis of the 200 shares becomes $50.52. Now, why the idea of an in-the-money call? When we chose an in-the-money call, we wanted higher upfront income, a lower break-even, and more downside protection. For in-the-money call, we have to be completely okay with assignment. This was not a trade where I was hoping for a massive upside move. It was a short duration, controlled income trade. Now, let's walk through every realistic outcome using realistic numbers so you can clearly see how this strategy behaves. Now, the first possible outcome could be TQQQ finishes above the strike. Now, let's say TQQQ rallies and finish at $56 on 16 Jan. Because the strike is $51.50, my shares are called away. So here are how the numbers look. I bought the shares at $54. The shares are sold at $51.50. The stop loss is $2.50 per share. The option premium collected was $3.48 per share. The net result per share becomes positive 98 cents. And in this case, the total profit is $196. This is the maximum profit for this trade. Now, outcome number 2. TQQQ finishes exactly at strike. If TQQQ closes at $51.50, the outcome is the same. Shares are sold at $51.50. The premium is fully capped. The final result is $196 of profit. No guesswork, no drama. Next, what if TQQQ finishes slightly below? Let's say it finishes at $51. We will keep the shares. The stop loss now become $3 per share. The option premium collected $3.48. Now the net results become 48 cents per share. It is still a profit of $96. We still make money and we get to keep the shares. Next, what if TQQQ pulls back but stays above break even? Now let's say TQQQ closes at $50.75. We will keep the shares. The stop loss now becomes $3.25 per share. The option premium collected $3.48, and the net results is positive 23 cents per share. We still collect a profit of $46 in total. So even with a slight pullback, the trade is still profitable. Now next, what if TQQQ drops below break even? Let's say it finishes at $48. We keep the shares. The stock loss now becomes $6 per share. The option premium collected, $3.48 per share. The net result now becomes negative $2.52 per share. And now the total loss is $504. Well, it's a loss, but it's still smaller than owning TQQQ outright. Now, the last possible outcome. What if TQQQ crashes? Let's say it crashes down to $42. We keep the shares. The stock loss now becomes negative $12 per share. The option premium collected, $3.48. The net result now becomes negative $8.52 per share. The total loss is $1,704. It's painful, but materially reduced by the option premium. Now, if outcome 5 or 6 happens, I'm okay with it because I'm using TQQQ, which is tracking the Nasdaq. I believe it has the ability to move higher. That's why the underlying that we use for the option trade must be something we are willing to hold on to and must have good liquidity and some volatility to generate good premiums. Now I'll review what actually happened. Alright, on 15 Jan 2026, one day before expiration, I closed the entire trade. I sold all my 200 shares of TQQQ at $55.42. I bought back the call options at $3.95. Now let's break it down. On the stock side, I bought the shares at $54. I sold them at $55.42. So the profit per share was $1.42. So for the stock profit, it was $284. On the option side, the option loss per share was negative 47 cents. So the total option loss was negative $94. So for the net result, the final net profit was $190. And that took about 10 days. Now this trade did exactly what it was designed to do. It wasn't about maximum upside. It was about structure, discipline, and probability. And in the money covered call, it lowers your break even, it reduces the downside risk, and it produces more predictable outcomes and good cash flow. And for me, that trade-off is worth it. Now, if you find this breakdown helpful and help you understand in the money covered call better, please like the video and subscribe to the channel. It really helps the channel to grow. Now, let me know in the comments, what do you think of selling in the money call options? Have you done it, or do you think it is not a worthy strategy to use? That's all for today. Thank you for watching, and I'll see you in the next one.